Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE. This is Get Rich Education, episode 193. I'm your host, Keith Weinhold. Today, I want to tell you how you can best get rent increases on your existing rental properties. And then later, a guest will tell us about some of the latest real estate investing trends, including the one city where Amazon is most likely to locate their second headquarters among those top 20 cities that Amazon has narrowed it down to, and why all of that matters to you as a real estate investor even more than you know. A lot of people ask me where I get my information on real estate investing. Well, one of those places is Atom Data, and they're one of the world's very best places for cutting-edge research on United States housing. Well, Atom Data's senior vice president's name is Daren Blomquist. Well, we're going to have Daren Blomquist on the show with us today, so I think you're going to love today's chat. But first, piggybacking a bit off of last week's episode, we were talking about rent problems and tenant issues. Let's discuss something more positive, raising the rent. Now, part of the power of real estate investing is really in raising the monthly rent amount. I want you to consider what few real estate investors consider. And I was just talking about this very phenomena when I was a guest the other day on a Dallas, Texas real estate investing talk radio show. Look, if you own a property that rents for, say, $1,000 a month and has a monthly cash flow of $200, well, then a rent increase of 3% on your tenant is only $30 a month to them. And 3% is pretty much in line with inflation. And $30 is not a big increase to many tenants. Now, here's the motivation for you. Understand that $30 increase transfers straight to your cash flow. Well, now your $200 cash flow has just bumped up to $230. Well, that's a 15% increase in your cash flow. If you extrapolate that effect across your entire real estate portfolio, look at what you have there. Yeah, you have just leveraged a rent increase because a 3% hike on your tenant means a 15% income boost for you in this case. And you start to get an idea of the gravity of a rent increase and how that's such a positive phenomenon for you. And gosh, this is just another reason that you've got to love real estate investing. I want to see you increase your income. And we're going to talk about how you can best do this. And you deserve a rent increase because, again, we are here to do good, provide housing for society that's clean, safe, affordable, and functional. And as long as there is wage growth in the market where you're invested, and especially wage growth in those sectors where your tenants are employed, well, then they can weather a rent increase. And to your tenant, if their wage increased 3%, then their rent increase from $1,000 up to $1,030 really isn't much of a real increase at all. Well, that's awesome. But here's the problem. A lot of tenants aren't going to see it that way. So let me tell you about how to get a rent increase the right way. And first, here's the wrong way. And it's a mistake I made when I was first living in that owner-occupied fourplex back in the day. And this was back in my first year or two of being a real estate investor. What I did when the tenant's annual lease was almost up for renewal is that I left them with a letter saying that I was increasing the rent by 3%. And the reason that I cited in that letter was due to monetary inflation. Well, that tenant promptly responded by giving their notice and leaving. And he was a really good tenant too. He did a whole lot of handy stuff around the building I didn't know how to do. Okay, so you and I think differently than your tenant does. They don't want to hear about inflation because that doesn't seem real to them on some levels. They might not even understand that. You need something more concrete, okay? They don't get inflation. Your tenant doesn't subscribe to Richard Duncan's Macro Watch. Your tenant probably doesn't listen to Get Rich Education, although I would encourage them to do so. And your tenant, they don't go around quoting Steve Forbes and Milton Friedman. So yes, if it's executed poorly, depending on who you're serving, I know it seems incomprehensible, but your tenant will pack up and move over a rent increase of as little as $30, depending on who you're catering to. Yes, they will potentially say, I am uprooting my entire family and all of our belongings basically over the cost of a large pizza with pepperoni and extra cheese. That's it. I'm gone. Over $30. I'll change over the utilities and I'll go learn a new neighborhood, everything. Okay? Some tenants don't understand finances and they think that you are already some fantastically wealthy investor. You know, most tenants don't even realize that you have a mortgage on your rental property. So once again, I want you to think about how your tenant is thinking. Inflation is not visible to most people. I've called it the invisible tax, the stealthy thief. So no wonder tenants don't want to acknowledge inflation. Look, even if you have a reasonable expectation that your tenants are getting wage increases, suspecting that they've received a wage increase still isn't something that you want to acknowledge on your notice of rent increase form. I mean, how would that come off feeling to your tenant? It can come off like, I know you got a pay increase, so part of it should be mine. So you don't really need to provide any substantiation or justification to your tenant for raising the rent at all. In fact, zero justification, that's probably better than citing inflation or that area wages are higher. So here is how you can best position yourself for success with getting your rent increase to stick. Number one is to put it in the contract. Have a rent escalation clause in the initial contract that they sign right before move-in. Your property manager is going to know better than anyone else whether rent escalations are appropriate in your market. Dallas and Atlanta are two that come to mind right away, especially Dallas, where rent escalations are really working because they're seeing such rapid job and wage growth there. They're working in a lot of other markets too. A rent escalation clause inside the lease agreement, now that might show that the tenant's rent will be $1,000 in year one, $1,030 in year two, and $1,060 in year three. The tenant signs that before they even move in, and then that way there just aren't any surprises that you're going to be springing onto the tenant. You have already cemented your tenant's expectations. So I like the escalator. And rent escalation clauses are more common in commercial leases than residential leases, by the way. But I like the escalator. Whether you use one to make rent increases or not, I would advise you to make your rent increases on your tenants gradual. If you have a longer-term tenant that's been paying you the same rent amount for 5 years, and then before year 6 begins, you give them notice that their rent is going up 20% all at once, well, then you can pretty much count on the fact that you're soon going to have a vacancy there. So the lesson is, if the market is right, include small rent increases at each annual renewal period, like a 2 to 4% increase. And really, in almost every case, if your tenant signed a lease, you cannot raise the rent until that lease period has expired. The next lesson is that you, or of course, when I say you, it's your manager preferably, of course, you should give notice that the rent is going to increase 60 days before the lease ends, and of course it needs to be in writing. That's because under most state laws, the tenant needs to provide you with a reply with 30 days notice of their intent to vacate, and you want to have your lease written so that your manager has the right to show property to your prospective new tenant while your old tenant is still living there. And that's because you don't want to be playing catch up. You don't want the existing tenant to already be moved out before you even start showing it to the next tenant, or else you have just increased your occupancy gap there and you're adding days to your vacancy. I would add that you need to know the market rental rates. There are more and more online platforms and more assistance for best determining rental rates in a certain market. And those tools keep getting better, but still no one knows better than your property manager in that market about what that market rent should be. Think about it. Your manager might manage 800 units right in that market, many of them for the same use type of the property that you own. And maybe 100 of those 800 units might be very similar to yours. So no one is going to know that market rental rate better than your property manager. Well, if you're invested in a market that can withstand rent increases, I'll tell you what typically goes inside your notice of rent increase letter. Here's how it should look. So you, or again, your manager, can send it through either email or paper mail. Start it by thanking your tenant for being such a great tenant. That should be one of the first things stated right there in this letter. Compliment that tenant on their good attributes like paying the rent on time or taking care of the property, and then get right to it and say that you need to raise the rent. You can add an explanation if you like, perhaps that property taxes have increased or paying your maintenance costs are greater. Don't put anything in there about inflation. And that you need to keep up with your expenses. Point out that you are raising the rent as little as possible and that you hope that they will stay with you. You need to state what the new rent will be and the date that it becomes effective, which is going to be the day after the lease ends. And if you have a fixed term lease, you could include or attach a new lease with your letter or email. Again, hopefully your property manager is already doing this. They have a template, they have a system, but this is really what goes on behind the scenes. And ask that your tenant read the new lease and that they sign it and that they send it back to you. Explain that you've highlighted or you've underlined any changes in the lease agreement, including that rent increase, and then everything else remains the same. And there you go. So those are some of the mistakes to avoid and some tips for helping ensure that you get the rent raised, and that is everything that belongs in a rent increase letter and what doesn't. And if you've raised the rent, hey, congratulations, you deserve it. You are not a slumlord. That's not ever what we advocate for here at Get Rich Education. You have been an ethical operator. You've served a tenant or a family with good housing. And consider, too, that you're taking on more real estate commitment and risk than your tenant is in this transaction. So for you, this is your reward. Well, it's interesting. I spend much of my life traveling around the U.S. and sometimes outside the U.S., visiting different markets and providers, and then I compile the best property providers for you at turnkey.com. This is just always something that I've enjoyed doing for years anyway. Well, sometimes when I visit these markets and sniff around for a few days, I'm often the very first person to tell a turnkey provider that their product is going to resonate nationally. Well, how do I know what's a good market to begin with and what isn't, and where just might be a good place and what wouldn't be, and where do I get my information from? That's a question people commonly ask me. For example, a few months ago, I shared with you that a major media source named their top 5 cash flow real estate markets in the U.S. for 2018. And of those top 5, 4 of them were already on turnkey.com, every one of them except for Detroit. Well, how did I know that when there's so much information out there, and who is aggregating the right data into something that's actually usable and cuts through the noise? Well, for one thing, I would say that having your feet on the ground just can't be truly replaced. There's nothing better than that. But in addition to that, Atom Data is one such place where they compile and aggregate info specifically for real estate investors, and they use some techniques that are pretty cutting edge. One thing we'll discuss is where Amazon is most likely to locate its second headquarters, and that would be a place where you can expect rent increases. We're talking with Atom's Senior Vice President right after this. You're listening to Get Rich Education. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. RIDS provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Adam Data Solutions is a company whose mission is to increase real estate transparency, and they do that by arming businesses and by arming individual investors and consumers like you with the property data that you need to make wise investing decisions. And Adam's Senior Vice President is with us today. Welcome to Get Rich Education, Daren Blomquist.
Great. Thanks for having me, Keith.
Daren, one way that you bring value to businesses and individuals is you have a regular publication called Housing News Report. And gosh, that thing is just always full of great real estate information with charts and with interactive maps. And really all of it is specific to making real estate investment decisions. And, you know, in your latest issue, you had some things in there about Amazon HQ2. Now, just to drop back so everyone's with us, last year, Amazon put out a request for proposal. It's an RFP in the business world. And they did that to basically bait cities across the United States to start falling all over themselves to win Amazon's coveted second headquarters to add to their first one, which is in Seattle. And that's known as Amazon HQ2, Headquarters 2. Tell us about some of the takeaways and conclusions that you and Adam came to, Daren.
Yes, and so, you know, the scope of this ranking, we're not trying to be Amazon here and be Jeff Bezos with this, because there's a lot of things that they're taking into account that we may not be looking at. But using our public record real estate data that we have access to, property data, neighborhood data, basically is the core of it. We're trying to rank these markets. It's actually 19 markets. We don't have data for Canada, so it excluded Toronto.
Okay.
So we looked at 6 factors affecting the housing market and quality of life. And based on that ranking, that's how we came out ahead. I would say the bias in here is toward affordability. We were looking through the lens of someone who's moving to that market and to get a job at Amazon. Are there homes for them to buy? Is there affordable housing in that market? So we looked at affordability, just median home prices. We did look at home price appreciation. Then we did look at schools, crimes, property tax rates specifically, which is part of course, the affordability equation as well. And so what we came up with is a list that it was surprising, and it actually got a lot of coverage in the news because it was a little bit counterintuitive to some other studies out there. There was one recently that had ranked, some AI had ranked Boston as number 1. We actually ranked Boston at the bottom of the list as the least favorable real estate market. And a big part of that was because of the higher home prices there. Yeah. The median home price of $670,000, that hurts affordability. And then, of course, actually the schools and crime was kind of middle of the road there. Schools along the lower side, and so that brought Boston down to the bottom along with the affordability. But then at the top of the list is Raleigh, North Carolina, which I think a lot of real estate investors would say, yeah, a lot of North Carolina markets have been getting a lot of attention, I think, from real estate investors lately, and justifiably so, because you do have some great opportunity there. But Raleigh was a little bit of a surprise because it's a smaller city. It doesn't maybe have some of the infrastructure that Amazon would be looking for, but it's got affordable homes, median price of $235,000 versus the $670,000 in Boston. And it's got good schools and low crime and low property taxes as well that really brought it up to the top of the rankings.
Well, that's interesting. And you bring up affordability as a key indicator. And I think of affordability as median home price divided by median income in a market. Do you agree with me? That's pretty much affordability, more or less.
Yeah, it's that ratio of income and price to price. And there's slightly different flavors of how you calculate that. But we actually just did a straight price to income ratio for this affordability measure.
Now, some people might wonder why this is a thing of talking about where Amazon might locate HQ2, their second headquarters. This is potentially seismic in the business world and seismic for the metro that they choose. We're talking about 50,000 or more jobs, and not just jobs, but somewhat higher paying jobs. And these jobs have an average salary of about $100,000. And there will be a ripple effect. This will go beyond just Amazon. I mean, this can shift where other companies decide to locate. And this has ramifications for real estate, not just residential, of course, but all types, industrial, commercial, office, and residential. You heard Daren mention 20 cities. Amazon narrowed their list of candidate cities to 20 some months ago, and it's just been very popular in the media to predict where HQ2 is going to go. A lot of people look at the southeastern quadrant of the United States. I mean, if nothing else, that has one advantage because it's just opposite of where Seattle is in the northwestern United States, where their first headquarters is. As Darren's talking about, they have a lower cost of real estate than the northeastern United States. Some of those cities on the top 20 list, like New York, Boston was mentioned, Toronto, D.C., they all have a higher cost of living than some places in the southeast. Philadelphia and Pittsburgh are two places that have a somewhat lower cost of living in the northeast compared to those other cities. So, yeah, I mean, Daren already let you know, Raleigh won. So third was Pittsburgh, is what the Atom Data Solutions finding showed us, that Pittsburgh would be the third most likely city for HQ2, Atlanta second, and then Raleigh first. And when is it going to be revealed, Daren?
Amazon has not said when they're going to reveal it. I believe it's the timeline they've given is sometime this year. So there's still some time there. And I believe the indication they've given is that they're going to probably narrow the list at least one more time before they announce the final winner. And so that'll be interesting. But you're absolutely right about this being a seismic shift, especially for a market like Raleigh, which is a smaller market and it will have a huge impact. But it certainly strikes me that of the 19 American cities on this list, 16 of them have median home prices that are below the median home price in Seattle. So to me, Amazon is tipping their hand that they're looking for a market that is more affordable. They've become a little bit of a victim of their own success in Seattle. And actually doing this report, I talked to media and reporters in Seattle who basically acknowledge this, that, hey, look, they're having trouble hiring people for their Seattle headquarters because of the cost of housing in Seattle. And so I think for sure that's an important factor. Among others, availability of jobs is huge. But this whole discussion, it's kind of fun in the media out there, but I think it's important for real estate investors because, first of all, if you can figure out where Amazon's going to go, that's a great opportunity for real estate investors, or at least be one of the first to start investing in that community. But then even beyond, the broader implication from this is you can evaluate real estate markets in a similar way that in an Amazon or Apple, which is also looking at Raleigh, or a smaller company might evaluate, and from that perspective, make your investment decisions that are well grounded in data about where you should be buying properties to invest in. And using that data-based analysis, I think whether or not Amazon ends up in the market, whether you win the lottery and you choose the right market that Amazon's going to be in, as long as you're using that data-based analysis, you're going to be on solid ground in terms of seeing your investments grow over time by looking at the quality of life, affordability as a factor, home price appreciation over time, and things like that.
This is an opportunity for an investor to ride a wave if they can choose correctly. And a lot of our investors deal with residential. There's always going to be a need for residential. Housing is an innate human need. And one really interesting thing that you do there at Atom Data Solutions that I see in your publications is that you grade neighborhoods. You grade neighborhoods A, B, C, D, or F. You give them a grade, and you have these interactive maps that include some really interesting granular data. So, for example, within a certain zip code, you can see what the gross rental yield and even the gross flipping ROI, what those numbers are within specific neighborhoods. Tell us more about that.
Yeah, that's right. And we actually did that for the first time last year, that report you're referring to, and we'll be coming out with an updated neighborhood index. That type of data doesn't change too much over time, so we only update that once a year. But yeah, we did it. We're combining this property data that we have that helps us determine investment potential. That gives us, okay, people who are flipping homes, what's the returns they're getting on average on homes, along with the returns on rental properties. We're combining that property data with this neighborhood data, which we have, and actually over the past year, we've gotten better neighborhood data through acquisition of a company called OBI, or Onboard Informatics, and that includes schools, crimes, points of interest, and really taking the investment potential piece is not part of the neighborhood grade. It's really those quality of life neighborhood factors that help us grade the neighborhood from A to F, and we use an index basically to do that. But then on top of that, we layer on the investment potential. So what is really cool for me in looking through that data is you can find those hidden gems of A-rated neighborhoods that have still great cash flow potential for rental properties, for instance. Now, those are going to be in the minority. A lot of those A-rated neighborhoods, because they have the nice schools, are going to be selling at a premium price.
Yeah.
And so it's going to be a little more difficult to find that. But there are those hidden gems there where there's A or B rated neighborhoods that are still producing great cash flow if you're looking for rentals or great flipping returns. Now, the flipping is usually a little bit more. You do see the poor quality neighborhoods yielding great returns on flipping because a lot of times flippers are speculating a little bit more than single family rental buyers would be on saying this neighborhood is not there yet, but it's improving. And so we're going to bet on this neighborhood to be getting better. But that's the fascinating part for me is finding that. And the opposite way is, looking at neighborhoods that yield a great return potentially, but that neighborhood may look great on paper in terms of the returns that you can get, but it comes with a risk because of the quality of schools, the crime, and maybe higher property taxes is also something we take into account there because that's a cost that sometimes investors don't think about.
Right.
That comes with owning a property. And so you want to look at those neighborhoods that maybe look great on paper in terms of returns, what the risk factor might be in terms of vacancy, which is another factor we include in our reports, vacancies, and just the cost of owning a home in some of those markets.
Yeah, you break down the data to really granular, useful stuff. And, it's really interesting, Daren, because us as investors that are interested in cash flow, we want to sort of buy in a neighborhood or a submarket where it's an attractive place to live, but only somewhat attractive, because if it's too attractive, kind of like you're talking about, and we start to tilt into beautiful and having a lot of amenities or having a view of a great lake or an ocean, well, then it becomes so expensive that you can't make a cash flow anymore. So we're just kind of seeking out somewhat attractive areas.
Yeah.
And it's really interesting to think about flipping. Sometimes I think about flipping, and flipping activity is potentially being predictive of where a good buy and hold area might be.
Yes, that's right. I think the flippers are in some ways the front lines of the real estate investment world, depending on the context you're talking about. But they're going to be more willing to go into a neighborhood. And of course, they have less risk in some ways because they're not planning to hold on to that property for a long time. So as long as they can get it flipped for a profit, they're not as concerned with the quality of the neighborhood over the long term. But yes, that's interesting. And to your point, it could be a great indicator of, okay, let's look at some of the hottest neighborhoods where there's a lot of home flipping going on. That could be a sign that neighborhood is on, being gentrified, on the upswing, whatever you want to call it, that would make it a good market going forward to buy rental properties in.
That's right. We're looking for those leading indicators so that we can catch a wave. Well, Daren, are there really any last things that investors ought to know today with everything that you do over there at Adam Data Solutions, from migration patterns to housing supply to demographics?
There's tons, and a lot of this information we're putting out for free in our newsroom. That's a great place to go. For instance, this neighborhood index. You can go in and use the heat map that you were describing, and that's in our newsroom. But if you just go to our newsroom, and you can look through all the articles we're putting out and reports for free, and hopefully those are very advantageous for you. But that's just Adam Data, and Adam is with 2 T's, www.adamdata.com/news. Or you can just Google, for instance, on the neighborhood index, Adam Data neighborhood index, and you'll find that way. So that's a great resource. And then taking it a step beyond, we have tons of stuff we cover that is above and beyond what we've just had time to talk about right now. But I would say, one resource that is great for investors once you identify the areas that you want to go into is actually finding properties to purchase. We have a great tool for investors called our Atom List product, where you can create marketing lists of properties that match your criteria in the markets that match your criteria as well. And that's just the website of list.atomdata.com. And you can go in there and basically you're able to mine our entire database of properties nationwide. We have 155 million US properties in there with tax assessor information, all the transaction information of purchases of the property, the mortgage information, foreclosure information. So you can use all of those and more to filter out, create a list of properties that might fit your criteria to purchase. So that's a great resource as well. And it starts at about 13.5 cents per record, but depending on volume, you can get it for less than the 13.5 cents per record to download that data.
Atom Data Solutions, that's spelled ATTOM. Daren Blomquist, thanks so much for coming on to the show.
Thank you, Keith.
Some pretty useful information from Daren Blomquist today. Not long ago on the show here, we discussed single-family homes and why Central Florida is such an advantageous market for them. A couple weeks ago, we discussed duplexes and fourplexes. Well, on next week's show, we're going to keep going bigger and discuss the investing landscape for larger apartment buildings today, and with none other than the apartment king, Brad Sumrock, so that ought to be a great show. Farther down the road, the father of the 401k, basically the man that helped invent the 401k, will be here on the show with us. And I am going to ask him point blank about how 401ks were originally called salary reduction plans and that they still could be called that. And I'm going to ask him if 401ks are really serving people. I mean, come on, just cut out the salary reduction plan and opt in for a salary increase plan with cash flowing real estate. What kind of life do you want to design for yourself? Hey, to learn more about Daren and his company's valuable work, check out atomdata.com. That's spelled ATTOM, data.com. I appreciate you as a listener so very much, and I just want you to know that. Here's a reminder to subscribe to Get Rich Education by just simply touching the subscribe button on your podcatcher. That is the easiest way to be sure that you never miss any episode. Until next week, live a life of abundance. Don't spend one day following money when with a shift in mindset, you can now make money follow you. Although you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.